now. So for example, I have a longer term inflationary outlook, but a nearer term economic slowdown, recessionary type of outlook. And when we look at recessions, a lot of people think in Boolean terms, like either you're going to have a recession or you're not. Whereas, perhaps a simpler way to look at it is the economy accelerating or decelerating, and what are the leading indicators say is likely to happen in the coming quarters. So, for example, in the past, say prior to the whole COVID crash, that whole 2010s decade of economic expansion, we had what was technically an economic expansion for over a decade. But if you look at the acceleration and deceleration figures, we actually had three mini cycles. They were roughly at 3 to 4 year increments within that 10 plus year economic expansion. We had a couple near recessions and things like that. And so not all economic decelerations become recessions. Sometimes they're averted, sometimes they put stimulus in, sometimes they juice it up to keep it going. Other times it does fall into a recession. And so what we can pretty much say, with obvious certainty is that since 2021, the U.S. economy has been on one of those decelerating paths. And so, for example, you can look at the Manufacturing Purchasing Managers Index, PMI. That looks like a sine wave. It kind of ebbs and flows over, say, 3-year periods roughly. That's been in a clear downtrend since kind of the middle of 2021. And in the past couple months, it's entered contraction territory. So it's just below 50, contracting. That's generally where it gets to in economic decelerations if it stops there, right? So if it starts to roll up, you can get kind of a slowdown, but not a recession. If it keeps going down from here, that's more indicative of actually becoming a recession. There's a number of other, the Conference Board leading indicator, for example. There's a number of different economic indicators that show sharp deceleration with a high risk of recession, later this year. And the warning signal that a lot of people focus on is the 10-year minus 3-month yield curve, and that's often a differentiator between an economic slowdown and a recession, because that usually does not flash an inversion warning sign during those slowdowns that don't become recessions, but that does tend to flash before an actual recession. And so, for example, in the past 10 years that I talked about, those various ebbs and flows, none of them had inverted yield curves until you got into that 2019 period, which is when it started to signal potential recession. That's when you had the Fed starting to cut rates, the famous Powell pivot, and that was all pre-COVID crash. We were basically already showing signs of recessionary indicators. And so I would say right now we're in a clear, it's obvious downtrend, and the big question is whether or not we'll turn into a full-blown recession or not. I would say that more indicators suggest that we are going to probably enter recessionary conditions rather than not.
In the more likely than not recession that you see approaching, what would be likely outcomes both from the equities as well as perhaps real estate that people should expect in that kind of environment?
So I think it's more likely to be a stagflationary type of recession, maybe a longer grindy recession, kind of like the 2000, the post-2000 recession, when you had that kind of a long bear market. You had instead of like an epic economic crash, you had like this malaise, this grinding contraction that played out, compared to say the blow up in 2008 or the abrupt shutdown of 2020. And one thing I look at a lot is the banking sector, basically determining the health of the banking sector. And so going into the 2008 crisis, the banking system was the unhealthiest it had been since literally the 1930s, right? So you had basically the most leveraged banking system like in our lifetimes. And you can measure that in various ways. You can look at, for example, bank loans as a ratio to the base money, right? So the monetary base. How levered is the financial system? That's one way of looking at it. Another way of looking at it is you take all bank assets and you say what percentage of them are in nominally risk-free assets. So treasuries and cash balances at the Fed, right? Those are technically in the way our system works. They're not inflation protected, but they're nominally considered free of default. What percentage of their assets are in those? And going into that 2006, 2007 period, you had record low allocations to those nominally risk-free assets, which meant record high allocations to things that can default. So loans, riskier securities, things like that. And so what we see here is that after the banks were recapitalized after that whole event, now bank balance sheets are healthier. They're basically they have a historically high allocation to treasuries and cash at the Fed, and they have, pretty low allocations actually relative to their full asset base compared to loans and riskier securities. And so the way I would describe it is that, to the extent that we have a recession, we're unlikely to have a financial crisis that starts in the banking sector, right? So last time, the 2008 crisis, it emerged from real estate, from banking, and now it's likely to materialize in other places. And one of the differences you have between a disinflation or a deflationary crisis versus an inflationary one is that health of the banking system, right? So this is more likely, if you don't have that problem in the banking sector, and instead you have problems elsewhere, public finances, energy sector, things like that, that could actually more likely translate to a stagflationary type of recession. So I would say that we're in the more grimy type of recession most likely, rather than this big banking implosion that a lot of people are maybe looking for.
Well, one of the things, there's two sides to every coin, and metaphor isn't perfect here, but anyway, if the banks have more stable balance sheets currently than they did then, is it because they've already drawn in their horns, as Alasdair Macleod would say, and are less confident of wanting to lend out right now, either to businesses or to other banks, etc.?
So yeah, and it depends on what time frame you're looking at. That's kind of been the story for the past decade. That combination, there were regulations put on them that changed their risk profile, but then also just on their own devices, they were more reticent to lend. So that's like the longer term story of the past decade since that crisis. But then in the more cyclical sense, generally, this is another kind of recession indicator, is that they do surveys every quarter of banks, and they say, are you tightening lending standards or are you loosening lending standards? And they kind of weigh the percentage of banks that are answering one way or another, and then they break it down. Are you more likely to lend to large firms? Are you more likely to lend to consumer credit? Things like that. They generally all go in the same rough direction. And what we're seeing right now is that banks are very much tightening their stance. Now, they did that back in 2008 too, but they did it from a position of weakness, whereas now they're doing it from a position of relative strength. And that doesn't mean that banks can't be impacted negatively by a recession. It just means that the recession is unlikely to emerge from the banking sector. They can still be impaired by, business going out of business. They can't pay the loan back to the bank. So banks can have loan losses, they can have impairments and things like that. But the difference is that it's unlikely to emanate from the banking sector, and instead it's more likely to emanate from other areas in the economy.
Could you focus for a few moments? You gave one example there, struggling businesses unable to pay back their bank loans. What other examples are there of areas that you foresee it's more likely than from the banks for the major serious impacts of a coming recession to emanate from?
So right now, because rates went up so high, we have the rate-sensitive industries that are particularly impacted, right? So even though housing prices haven't fallen sharply, housing activity has. So number of new starts, number of people buying and selling homes, because everybody's got these locked-in mortgages. Nobody wants to sell the home they have. And then also for new buyers, they're very unaffordable because you have the same house price, but now you have twice as high of a mortgage rate. And so that whole industry's dried up. So if you work in mortgage originations or home builders, you're probably not having a great time right now. Same thing is true for auto loans. Most people buy them on financing, or at least a high percentage of people buy them on financing. And so if the rate doubles, that makes them a lot less affordable, and you get slowdowns in people buying new cars. So those are sensitive. In addition, the technology sector, people often try to think of it as a non-cyclical sector, but it actually is pretty rate sensitive because, in an environment of basically zero rates, if the 10-year treasury yield only pays you 1%, there's basically no cost of capital. And so investors are willing to pay very high valuations for these long runway, unprofitable growth companies. And then the way these growth companies operate is they say, let's keep prices low. Let's just generate as much growth as possible. We don't have to worry about profitability. And instead, we'll keep issuing new shares to pay employees, for example. We'll give a big percentage of their compensation will be new shares that are highly valued and they keep going up. And the problem is that when you do get a cost of capital, if the 10-year treasury is 3%, 4% higher, now suddenly you have to re-rate those equities at lower valuations. You actually have a positive discount rate that you're comparing them to. And so those equities go down a lot more than, say, value stocks do. And the company can no longer just keep issuing more and more shares to employees and keep them on the payroll. They actually have to pay their employees more of a salary type of situation. And so they have to raise their prices to try to be more profitable. They can't rely on that constant issuance of equity at the same rate that they were.